Hi everyone, imagine two neighbors, same street, same job, same income. Both own SCHD, both collect the same dividend check every quarter. But at the end of the year, one of them writes the IRS a check for thousands of dollars more than the other. Not because they cheated, not because they made a mistake, simply because nobody told them one rule. A rule sitting right inside the tax code, available to every investor watching this video. The rule is what this video is about. By the end, you will know exactly how your SCHD and SCHY dividends are taxed. The one account mistake quietly costing most investors thousands every year, and how a married couple can legally pay zero federal tax on their dividend income. Welcome back. This is Invest ED, where we turn big financial ideas into simple steps anyone can act on. Nothing here is financial advice. Always consult a licensed professional before making any investment decisions. Let's get into it. The IRS puts every dividend into one of two buckets. The difference between them can cost you, or save you, thousands of dollars every year. Bucket 1 is called ordinary dividends. The IRS taxes these like a paycheck. Whatever rate you pay on your job income, you pay the same rate here. The 22% bracket, 22 cents on every dollar. The 32% bracket, 32 cents. Up to 37 cents for the highest earners. And if your income is above $200,000 as a single person or $250,000 as a married couple, the IRS adds an extra 3.8 cents on top. That brings the maximum to 40.8 cents on every dollar. Bucket 2 is called qualified dividends. Same money, completely different treatment, taxed at 0%, 15% or 20%. That's it. The gap between 37% and 20% is 17 cents on every single dollar. On $10,000 in dividends, that is $1,700 extra in your pocket. On $50,000, that's $8,500 every year, reinvested year after year. That gap compounds into a number that can buy you years of extra retirement income. Which bucket are your dividends landing in? Historically, nearly all of SCHD's dividends have landed in Bucket 2, taxed at the lowest possible rates, not your regular income rate. Check your 1099 DIV each year, but SCHD's track record on this is one of the strongest in the ETF world. Why? Because SCHD holds American companies across healthcare, financials, consumer staples, and industrials. The IRS gives the lower rate to dividends from U.S. companies as long as you hold a fund for at least 61 days around each payment date. Every long-term SCHD investor meets this automatically. SCHD is not just paying you growing dividends. It's paying you growing dividends at the lowest possible tax rate. That is a double advantage most investors never fully add up. SCHY holds companies outside America, Japan, Germany, the United Kingdom, Switzerland. The IRS treats foreign dividends differently. Some of SCHY's holdings land in Bucket 2 because they trade on major U.S. exchanges or come from countries with tax agreements with America. But not all. Each year, a portion of SCHY's income lands in Bucket 1 and gets taxed at your regular rate. This does not make SCHY a bad investment. The yield is strong and the diversification is real. But where you hold SCHY is one of the most important decisions you will make as a dividend investor. Almost nobody is teaching this. Here's something even fewer people know. When foreign companies pay taxes to their governments and pass dividends to you, you may be able to claim a foreign tax credit. But only if SCHY is in a taxable account, not a retirement account. This credit reduces what you owe dollar from dollar. Say SCHY received $300 in foreign taxes on your behalf. That $300 appears on your 1099 DIV. Your tax professional applies it directly against your U.S. tax bill. Most investors leave this on the table every year. That credit is yours. Here is the strategy nobody in this space is laying out clearly. It is costing dividend investors thousands every year in completely unnecessary taxes. Most investors put SCHD inside their Roth IRA to protect their best investment. It feels smart. It feels safe. It is the wrong move. SCHD belongs in your taxable brokerage account because nearly all of its dividends land in Bucket 2. They are taxed at the lowest possible rate, as low as 0%. Putting SCHD inside a Roth IRA wastes your most valuable tax-protected space on an investment that already has a built-in tax advantage. SCHY belongs in your Roth IRA because a portion of SCHY's income lands in Bucket 1. Sheltering it inside the Roth eliminates that higher tax completely. Those dividends grow every quarter, and you never pay tax on them again. Not when they grow, not when you withdraw them in retirement. Same two funds, same dividends, completely different tax bills. One decision about which account holds which fund. Made once, saving thousands every year for life. Here is the fact that will genuinely surprise most people watching this video. If your total taxable income, after deductions, is below $49,450 as a single person or below $98,900 as a married couple, your bucket 2 dividends are taxed at 0%, not 1 penny in federal tax. A married couple in early retirement with combined income below $98,900 owes 0 federal tax on every dollar SCHD generates. 0. Legal. These thresholds adjust for inflation each year, but the 0% door stays open. Here is the hidden strategy almost no one is using. Between the day you retire and the point when the IRS forces withdrawals from your traditional IRA, there is a window. Your income is low. Your bracket is low. During this window, you can move money from a traditional IRA into a Roth IRA at a very low rate, sometimes 12%, sometimes lower. Financial professionals call this a Roth conversion. Once inside the Roth, that money grows and comes out completely free of tax for the rest of your life. Most investors never use this window. They wait too long. When required distributions begin, the government forces withdrawals that push them into higher brackets. Those who act during the low-income years lock in the lowest possible rates for life. Think back to our two neighbors. One put SCHD in the Roth and SCHY in the taxable account, paid ordinary income rates on foreign dividends every year, never claimed the foreign tax credit, never used the conversion window, retired with a tax bill nobody saw coming. The other did it the right way. SCHD in the taxable account, SCHY in the Roth, foreign tax credit claimed, conversion window used, same dividends and far more of every dollar kept. Here is what you do. Move SCHD to your taxable brokerage account. Move SCHY to your Roth IRA. Check your 1099 DIV every year and claim your foreign tax credit. If you're approaching retirement, talk to a licensed tax professional about the Roth conversion window before that low income period closes. The dividend tax trap is real. Now you know exactly how to avoid it. This video is for educational purposes only. Nothing here is tax or financial advice. Always consult a licensed tax professional for your situation. If this changed how you think about your accounts, hit the like button and subscribe. Are you holding SCHD and SCHY in the right accounts, or is this a mistake you need to fix? Drop your answers in the comments. I'll see you in the next video. Smart investing, profitable results.